Hello everybody, good evening. Welcome to JAIIB English Medium channel. I hope all of you are doing fine. Today in this particular session, we will be talking about Indian economy and Indian financial system. As you know that IE and IFS is the first subject for which the exam is scheduled on 3rd of May, and when we talk about IE and IFS, you must focus on specific modules as well. So module D is one such module from where maximum questions will be asked. Reason being the number of units it has. 17 number of units in a single module as compared to module A and B where only 19 units are there. But don't have this particular strategy that let's just focus only on module D and ignore the remaining portion. No, not like that. I just wanted to emphasize that you must focus on module D while you are starting your preparation. Fine. So today we will be learning the unit number 34th, that is your interconnectedness of market, or for that matter the market dynamics. And here more or less this interconnectedness is not at all about the regional interconnectedness. No, we are talking about the global interconnectedness as well, because we want to know for sure that what is the market dynamism which is involved in the financial markets when we talk about the global network. So we will be starting off with the basic process which interconnects the financial markets. Right? Financial markets we have seen in unit number 29th, that we talk about what? The credit market, then we have the money market. Also we will be discussing the interconnectedness in the capital market. So more or less these are the three major markets when we talk about financial markets. But for interconnectedness, one important, or for that matter the most important market would be forex, right? So the fourth one will be your forex market, where you will find good number of concepts which will directly link to your interconnectedness of markets, right? So the process via which we interconnect various financial markets, how it happens, that is the first topic. Then we will be shifting our focus to the reasons for this interconnectedness. There must be certain reason why we are trying to interconnect various markets into one, right? And this particular integration only will be learning in this entire chapter. What are the reasons? And once we understand the reasons, what is the importance of your interconnected market? Why cannot a market sustain in a secluded manner, in a singular fashion? That is also one of the discussion which we will be doing under the importance of your interconnectedness of financial markets. Then comes the heterogeneity of financial markets. Why we are integrating these markets? Reason being they are not at all functioning in a singular manner. They are already bifurcated based on region, based on various characteristics portrayed by a simple market, and based on various tensions which are involved via we talk about the financial market. So already we know that they are heterogeneous, they are not homogeneous, they are not integrated. We need to understand that what is the primary motto that we want to interconnect them. So heterogeneity of financial markets, if you understand this topic, then you will appreciate in a much better manner that why we are focusing on the importance of the interconnectedness. Then comes the achievement of market integration in India, because as I have told you earlier also, if you want to understand in a much better manner that how the markets function in the global level, you must start with the regional level, that is our country India. So here also we will be discussing about certain achievements, not all, certain achievements which we have accomplished over a period of time when it comes to the interconnectedness of the market. Then different levels of market integration is also there. Fine, level you can say regional level is there, then we have global level, or for that matter when we talk about the domestic level also within the country, across the globe, and some regions are integrated. That is your regional approach, where we find the special mention of your ACU, Asian Clearing Union. Fine, Asian Clearing Union, a comprehensive arrangement of various central banks wherein we try to integrate the markets based on the region, that is Asia. Then we have benefits and costs of interconnectedness of markets. Again, what are the benefits? More or less an extension of the importance part only, fine. So benefits, cost of interconnectedness, then interconnectedness of various markets specifically, starting off with interconnectedness of money market, fine. How the RBI functions, or for that matter, what are the tools via which the RBI will be regulating the money market, and how RBI will be having direct relation with the central bank of, let's suppose, Sri Lanka, Nepal, or for that matter your USA. Then interconnectedness of credit market, how the credit market functions within our country, because the banks are also connected via a simple, you can say, process, that is of your lending. Then we have the interconnectedness of capital market. The capital market is also very much you can say interconnected when it comes to the global level. Only based on the interconnectedness we are able to perform much more at a higher level as compared to the non-interconnected markets, because we have multiple options in the capital market when you talk about the global framework. Then the forex market, yes, that is also one of the interconnection which we will be studying. Lastly, the interconnection of your treasury operations, very important, fine. The treasury operations are the most important ones when it comes to the examination, fine. So treasury operations we will be learning in our classes, fine, the paid classes. Here we have elaborate discussion of the treasury operations also, and the most important effect or the phenomena known as the contagion effect. Fine. So when we talk about the interconnectedness, then you must think that it is only about the positives. It is about the positives, but what about the spillover effects? What about those effects which will be impacting not only the area with financial crisis, but the areas, the regions, the bilateral ties with which the country has from various members, like the example of AFC. Fine. We have the Asian financial crisis 1997. The southeastern you can say countries, they were having financial crisis, and the spillover impact was on various regions from where they were interconnected. So this particular effect where the negative impact spreads and it is very much contagious for those countries also is known as contagion effect. So all these terms we will be learning in the entire chapter of your interconnectedness of markets and market dynamism. So good evening, Selva Raj. Very good evening. Okay, so I hope the overview is clear to everyone. Now let's move on to the specifics. Starting off with the process. See, this chapter, unlike your previous chapters in module D, it is much more theoretical. Fine, you will find theory, the discussion is ongoing. So in the examination also, if the question comes, they will be talking only about the statement based questions, from where you will expect the characteristics, the process involved in these markets, the interconnection. So what is the process via which we can say that interconnection has happened over a period of time? So it started off with the development of economy and with the forces of globalization only. Earlier, when every country was having its own part to play within its domestic economy, no type of interconnectedness was there. Once the markets were open for various countries, within various countries, for having tie-ups with other countries, other nations, then only you can say that the process started of interconnection. So it starts off with the development of economy, because once the economy is developed, then only you will be having good relations, good ties with other nations as well. And with the forces of globalization setting in, the different financial markets in India are interconnected with each other and interconnected with the markets in other parts of the world as well. So markets are connected within our country, but along with that, they are also connected with the abroad based markets, fine, the markets which are present at a foreign level or the global level. Similarly, other countries in the world, they are connected to one another, and ups and downs in one part of the globe can have the resonating effect on the other parts of the globe as well. Like when we talk about the USA, fine, USA is having n number of sanctions on various countries nowadays. India is now an exception, but still some countries are there where this impact is detrimental for their economic progress. So all those countries, if you see their economic growth, it will be hindered for sure. In longer run, you will find that there will be certain hindrance. But whether it will be limited to them only, no. The trading partners of those countries will also have some negative impact, because now the countries which are doing good, they are not at all having the economic growth in the future if the situation remains the same. So whether we talk about the ups, that is the profit making exercise of various countries, or downs, which we talk about the contagious effect or the contagion effect, there you will see that the interconnectedness will have a negative impact also. This has been well seen whenever there was a financial crisis like the Southeast Asian currency crisis of 97 and the global financial crisis on 2008-9, when upheavals in the markets in certain parts of the world sent ripples like earthquakes in other distant parts of the world as well. So when we talk about the ripple effect, it is nothing but the after effects of a particular phenomena, and the particular phenomena which we are talking about here is your Asian financial crisis of 97, which started off with Thailand, spread over various other Southeast Asian economies, or for that matter the global financial crisis of 2008, which started off with USA, but ultimately various countries from where the people who were residing in USA were impacted. This is also known as coupling of economies, because you are not only having the impact in Asia, not only in Thailand, but the entire Southeast Asian countries, the entire region of that particular part of the globe. So the coupling will happen of the economies, and disturbances, when they spread, once they start spreading, then we call it as contagion effect. Fine. The spreading of negative impact of interconnected markets will be termed as your contagion effect. Like we say na, that this particular move of a country is contagious to its economic growth. It will be detrimental to its economic growth. That is what we are trying to say in the interconnectedness of financial markets as well. Now comes the part where we will be talking about the integration in a much more elaborate manner. So integration of financial markets, it is just a process of unifying the markets, enabling convergence of risk adjusted returns on the assets of similar maturity across the markets. You have a set of assets, fine. Let's suppose in India you have a set 1 where there are n number of assets, asset 1, 2, 3, 4, fine. These assets are lined up in our market, fine, and you want to trade these assets in the set 1 of, let's suppose, USA, fine. USA, somebody is there and they want to have an integration with the Indian market. So they also must be having certain assets comparable to your asset set, and once you start trading within various countries, among various nations, then we can say that integrated approach has been followed, fine. So interconnectedness will be established once you have the proper set of instruments which are having similar maturity, fine. The assets of similar maturity must be traded. You cannot just say that I want to have the interconnectedness in the derivatives market and you give me certain instruments from the money market. No, makes no sense, right? The process of integration is facilitated by an unimpeded access of participants to various market segments. if you say that we are restricting your movement in a particular financial market, let's suppose capital market, but we are saying that yes, you can move freely or have trade relations with us in case of forex markets. Do you think this is a sustainable model? Answer is no. Why? Because you should be able to understand that interconnectedness does not mean that only one financial market will be having the integration with the other. No, all the financial markets, if they are being integrated with the other country, then we can say that interconnectedness of financial markets is complete via the process of integration. Okay, financial markets all over the world have witnessed growing integration within as well as across the boundaries, and this is what we are looking for. Fine. Via this concept, we want to have a particular relationship between various markets across the boundaries, across the nations, spurred by deregulation, the globalization and advances in information technology. So earlier what used to happen, the markets were very much regulated, like we have seen in the previous lecture also, that the Indian government, it had good control over the exchange rate. Fine, the exchange rate was not deregulated, it was centralized, and because of that the market was not open at all. Once the decentralization or the deregulation of the rates happened, then only Indian forex market grew. Similarly, when we talk about the economic reforms of 91, where we opened our market for the global players, for the global market, the globalization process happened, and we can for sure say that integration has been succeeded. Lastly, when we talk about the information technology, so not only via the markets but also thanks to the enablers, and IT is one of the enabler of this integration. If there was no information technology, you won't be able to connect, you won't be able to communicate with the partner nations in a better manner. So all these things are very important when we talk about the process involved in the integration or interconnectedness of financial markets. Fine. So you must have similar maturity assets, you must be having a direct relationship between the participants. Fine, the access to the market segments should not be restricted. Also, the deregulation process, the globalization process and IT will ultimately give you the final answer when it comes to the interconnectedness. Now comes the next topic, that is reasons for your interconnectedness. Why do you want to be interconnected? You can have your own country being run on your own terms, right? Then why are you going for this particular process of interconnectedness? Answer is very simple, because we do not want to have a limited success in every domain. Limited success will come when you only have a restricted view about a particular financial market. But here in the interconnectedness or the integration of financial market, what is the essence? We want to have a broader aspect of your growth. We want that the capital must be accessible to you, and if you are in need, the countries will give you capital, they will give you money when you are closed or an open economy, when you are trying to become an open economy. So the implications of integration are as under: capital has become more mobile across national boundaries as nations are increasingly relying on the savings of other nations to supplement the domestic savings. In India also what happens? We have one of the mechanism known as external borrowings. Fine, external borrowings via which we finance our deficit. Fine, the deficit financing happens via the external borrowing. We don't have that capacity as a singular nation, but if we include other nations, if we utilize their savings, then we can definitely go for the overall capital requirement. We can fulfill our capital requirement. Then comes technology developments in electronic payment and communication systems. Now, when we talk about the technological development, why it is essential and why it is one of the reasons discussed here, because ultimately they have reduced the arbitrage opportunities across financial centers, thereby aiding the cross-border mobility of funds. What was arbitrage? Right? Arbitrage simply means that you are buying from a market where the funds are available at a low price. Ultimately, you are selling the same funds in a different market but with a huge leap of funds. Fine, you are having good amount of funding from the particular transaction which you have made. Fine, so that is the reason why the interconnectedness must be there. And when we talk about overall, fine, overall how you should have the operating framework in case of money market ongoing, why it is one of the reason. So the changes in operating framework of monetary policy with shift in emphasis from quantitative controls to price based instruments such as short term policy interest rate brought about the changes in the term structure of interest rates. So when we talk about the term rates, earlier in our monetary policy, the term rate was fixed for a longer duration of time, and if a term rate or the policy rate is there for a longer term, then the market has a perception about your country that you are not at all willing to change the key measures, the key characteristics of your economy. So yes, that is also one of the reason why now we can have much more interconnectedness, much more integration, because we now have a short term policy of your interest rate. Almost within 2 to 3 months you will find new policy being implemented by the RBI. Next is harmonization of prudential regulations. Now, when we say that prudential regulations are being implemented by the RBI within the country, then everybody knows that RBI wants to have strict rules being followed by the banks. But what about the prudential norms across the globe? If RBI is having the same norms and the other Asian economies are also having the same norms, don't you think so that it will become much more easier for the market players to get involved in the overall setup of financial markets, right? So that is also one of the reason why now we see good interconnectedness as compared to the earlier time, because of this harmonization of prudential regulations in line with international best practices enabling the competitive pricing of products has also strengthened the market integration process, right? So market integration process has definitely improved over a period of time, and when we talk about the overall structure, how it can be guided by the particular person. So yes, not only the entities, the business entities, but individuals can also have benefit from the interconnectedness thanks to these 4 reasons. Next comes the importance. Fine, you know for sure that interconnectedness is now present in your country. So what are the important areas which you must know about this integration? So importance of interconnectedness of financial market, there are various points why it is important to integrate the financial markets. First of all, it serves as a conduit, as a pipeline for authorities to transmit important price signals. Fine, if you have integration within your country, fine, within India and across the globe as well, so it becomes very easy for you to go for a particular case in which you will be trying to simplify the norms, trying to simplify the measures which are involved in the integration of your financial market. So definitely integration will serve as a pipeline for the authorities. They can directly transmit the important price signals. The fluctuations will be directly transmitted to the public. The benefits will be directly transferred to the public. The stability of the market will be directly transferred to the public. Efficient and integrated financial markets constitute an important vehicle for your promoting the domestic savings, investment and consequently the economic growth. Now when you have integration in the market, you must be knowing that you have the access to the market also, and accessibility is now much more higher as compared to the earlier times. And once you have the accessibility, you can make good decisions. You know for sure that yes, this particular decision I can take within a time span of, let's suppose, 20 minutes, 30 minutes, or for that matter 24 hours, and that particular decision will ultimately lead to either the positive returns or the negative ones. Right? If you don't have the integration in the financial market, how you can even take that decision? And supposingly the decision turns out to be a positive one, then what will happen? You will have good returns. Ultimately your savings will increase, and once the savings increase, the investment capacity will also rise, and which will help you to contribute towards the economic growth as well. So that is the direct implication of integration of financial market. It also fosters the necessary condition for country's financial sector to emerge as an international or regional financial center. So we have various powerhouses in our country as well as abroad also, where you will find that one sector which is on boom, or for that matter it is doing really well, is the financial sector. Reason being the integration again. So yes, the necessary condition which is there for your financial sector, which can emerge as the international or regional financial center. So India, why it is being preferred? Because of the cheap labor, right? We have the cheap labor here, and this labor will be very much fruitful for all of those countries who want to have maximum profit. And how they are accessing this kind of labor in our country? Via the integration. It enhances competition, efficiency of intermediaries in their operations, and allocation of resources contributes to the financial stability. Again, when you have the integration, you must be knowing that there will be a competition also. How much you have the access to the market, it is the similar level as compared to some other person who is residing within your area, within your country. So it will ultimately do what? It will ultimately imbibe the feeling of competition, and with competition we have seen that the profit will also rise, ultimately benefiting the economic growth. It leads to innovation, cost effective intermediation, thereby improving the access to financial services for the members of public institutions and companies alike. All these members will be having a positive connotation thanks to the integration of financial markets. It also induces the market discipline and informational efficiency. So you must be knowing that there is a term known as market discipline. In market discipline, it is not only about how much you invest, but how you invest. What is the efficacy of your investment? And you can have it from experience of yourself, or for that matter experience of others. And when you have the integration of financial markets, if your financial markets are already integrated, you can learn from the others' experience as well. Ultimately, you will be having the market discipline, with which you will be having a mindset where you do not spend money reckless. Right? The reckless spending will go down, and that reckless spending will help you to save more, again have more money for the investment, and consequently economic growth will happen. It promotes the adoption of modern technology payment system to achieve cost effective financial intermediation services as well. So more or less, when we talk about the interconnection, or for that matter integration of the financial markets, it will ultimately lead to what? The promotion of the modern technology, because based on the modern technology only you are able to have the integration. Now let's move on to the heterogeneity. What is the heterogeneity of financial markets? We are studying this topic of your heterogeneity. Why? Because we want integration, we want interconnectedness of these markets. That is the reason why it all starts with the heterogeneity. Fine. If it was already homogeneous, why would we be talking about the interconnectedness, right? So if the markets were not heterogeneous, or for that matter they were homogeneous. If they were already homogeneous, there would hardly be a case for their requirement in case of integration. Fine. So integration is there. Why? Because they are inherently heterogeneous. That leads us to the question, what causes the heterogeneity in the financial markets? Why the essence of financial markets is heterogeneous in nature? So the answer is very simple, nothing complicated, because as you have seen in the financial markets, we have different types of markets. Forex, we have the capital market, we have money market, the credit market. You cannot just say that 100% overlap is there in all these markets, no. And that is the reason why there is no you can say homogeneity. Fine. There is not at all they are not at all homogeneous, they are heterogeneous in nature. So some market segments, they are national, whereas others are international in nature, depending on where the financial transactions occur among the participants within a country's geographic boundary or across the border. Fine. So it's not like that only from Delhi, or for that matter only from Chennai you can initiate a particular trade or a particular, you can say Chennai, a particular Delhi, or for that matter a central location is there in Chennai from where you can initiate a trade. No, nothing like that. You can do trade from anywhere you like. Fine. So that makes it much more important, or for that matter relevant, to study the integration. Generally, money and credit market segments involving participation of banks, other financial institutions operating within the country's boundary are national in character. So we have the markets in case of money and credit market. It is what? It is within the country. The banks are where? Within the country only. Fine. Most of the people of your country, they want to access the funds from your bank only. Fine. Nobody is going to, let's suppose, Dubai or for that matter Australia to have the loan. Fine. So you can have credit market within the country, but what about the forex market? People are trying to trade abroad, they want to have the international benefits, but if we are sitting in India, then only credit market is accessible to us, or for that matter money market, the regulations of the RBI, they are applicable to us only. Nobody is talking about the regulations of RBI in Australia, they have their own central bank. Fine. So that makes this particular financial market structure as a heterogeneous one. On the other hand, foreign exchange markets dealing with cross-border transactions, stock markets with cross-listing of securities and participation of foreign institutional investors are international in nature. So you have a set of financial markets which are national, fine, which are domestic only, and the another set which is international in nature, and that makes it much more complicated to understand in a homogeneous manner. That is the reason why we call it as a heterogeneous market across the globe. Then we have some more reasons. Financial markets, they also differ in depth and liquidity. All the markets, credit, money, forex, capital, derivatives, do you think so that they have the same depth and equal level of liquidity of funds? Answer is no. For instance, money market instruments, they are more liquid, fine, much more liquid as compared to the bond market in your capital markets, fine, which are less liquid in nature. Also, the financial markets, they differ in the terms of economic nature of your instruments. Fine. Various instruments are involved in different types of financial markets. For instance, distinction can be made between the saving, investment, credit and derivative instruments. You don't see that the derivatives have the exactly same instrument when we compare it with the credit market. Fine. The credit market instruments are totally different when we compare it with the derivatives market. Financial markets, they are differentiated in the terms of risk profile also. We say that the government securities, or for that matter treasury bills, the sovereign bonds, they are having lowest risk as compared to the equities. Fine. They are highly risky. So the risk profile of instruments such as government bonds, which do not involve default, credit risk, corporate bonds, which are relatively riskier in nature. Fine. So we have that distinction also. Integration of market segment thus reflects an investor's attitude towards risk and the trade-off between risk and return on a particular asset. Fine. So risk and return, you must have that thing in your mind while studying the financial markets, which financial market you must opt for. And when we say that you have the choice where the risk is high, where the risk is low, automatically we are talking about the heterogeneity only. Market participants in different financial markets could be different. We have banks, non-bank financial institution, mutual funds are there, insurance companies, mortgage institutions, the specialized long-term financial institutions are also there. So the market participants also differ as we move from one market to another market. Fine, the banks won't be participating in some markets, or for that matter the NBFCs won't be participating in some type of markets. Fine, capital market directly you cannot have the relation of NBFCs with the capital market, or for that matter the derivatives market. Fine, not often they are participating. So that also have a repercussion in the form of heterogeneity of your financial markets, and that is the reason why we are studying this chapter also, which is known as interconnectedness of financial markets. Fine, now let's move on to the next topic, that is the achievement of market integration in India, whether we are able to have the integration or not. So simply stated, if I have to summarize in one line, answer is yes. We are able to integrate our financial market within our country also and across the globe as well. So the important objective of the reforms, the economic reforms 1991-92 has been to integrate the various segments of financial market for bringing about a transformation in the structure of the markets, thereby reducing arbitrage opportunities, achieving the higher level of efficiency in the market operation of your intermediaries, and increasing efficient transmission of monetary policy in the economy. Fine, we want to have such a market setup, such a financial market setup where we are not at all concerned about the ripple effects of other markets. We are not at all concerned about the ripple effects of, let's suppose, Russia-Ukraine war affecting our market, the Israel-Palestine war affecting our market. That is the achievement which we have made over the past 2 or 3 decades. Then comes the arbitrage. What do we mean by this term? Reducing the arbitrage opportunities. Why we want to reduce this arbitrage opportunity? In order to reduce the speculative trading. Fine, the speculations across the financial market, they will ultimately lead to many adverse impacts for a long-term economic growth, and in order to curb them, we have made this particular measure that we don't want to provide any kind of arbitrage opportunities to most of the individuals. But still, in the financial market you will find FIIs, find the foreign institutional investors, they indulge in what? Arbitrage only. So what is arbitrage? As I have already told you, it is a practice of buying an asset in one market and simultaneously selling it in another market at a higher price to pocket a risk-free profit. You don't want to risk, fine, you don't want to risk any single penny whatever you are holding in any form, in any type of market instrument. For that you have the arbitrage, buying in a market which is providing you the same instrument in a less price, selling it in a market with a much higher price tag. For example, when we talk about gold coin, so you must be knowing that the coastal areas of our country, since there the trade can happen in an much easier manner, so they have a relatively lower cost of gold, lower cost of making charges as compared to the northern states. And here comes the loophole which can be utilized via the arbitrage process. So you want to have a gold coin, fine, from a particular state in our country. So which state you would be targeting if you are following the arbitrage process? You will be following those particular states which are in the southern location. So the gold coin, for example, being sold for 50,000 in southern states, and you know that for sure in Delhi people are buying this same weight of gold coin for a much higher price, let's suppose 52,000. So if you directly buy the coin from Kerala and sell it immediately in Delhi, you will have what? A 2,000 rupees profit, and that is what is known as arbitrage opportunity. Quickly you are making the decision of buying and selling simultaneously, and you make the profit which is risk free profit. Fine, this one, risk free profit. Okay, fine. So yes, this was it for today's class. When we talk about the different levels of market integration, how you can integrate the market at domestic level, at global level, and at regional level, we will be learning all these in our paid classes. Fine, paid classes, we have various batches right now ongoing. The most apt batch right now will be the Mahapack. Fine, and why you should opt for Mahapack? Because it not only has the daily live classes, the mock test, the test series, the full length mock test will also be there. You will be having the recorded videos, ebooks, but also all the batches, whatever we will be launching for May 2026, you will be able to access all of them. And from where you can connect with our experts for buying this particular batch, directly you can contact us on 0981 981 9247, and right now we are offering huge discounts on the occasion of Mahashivaratri. The discounts pertain to flat 81 plus additional 1% discount plus 3x validity on the JAIIB Mahapack 2.0. And if you want more discounts, apart from the discount which we are offering on the website, then you can apply one discount code, that is Y1003, and you will have greater discount as compared to the 81 plus flat 1% off. Fine, you will be having much more discount as compared to this particular number. Fine. So yes, this was it for today's session. If you want to have discussion about everything in the IFS and want to solve more questions, then you can directly go to our website and enroll on the website with your JAIIB Mahapack 2.0. So if you have any doubts, feel free to ask me in the comment section. We'll see you in the next video. Till then, goodbye everybody. Take care.